The worst one took 25 years to heal. The fastest took about 6 months. If some quiet part of you suspects this time is the exception, that isn't weakness. Nobody ever showed you the timetable. So, 5 chapters and a ledger. We'll walk the real panics of the last 100 years, 1929, 1974, 1987, 2000, 2008, 2020, 2022, each with its measured depth and its measured recovery time attached. The 3rd chapter is the one pieces like this usually skip, because it's where the ledger stops being comforting and starts being useful. You won't leave with a prediction. You'll leave with a sense of proportion, which is the more useful thing to own. Picture a long table with a century of front pages laid out on it in order, different typefaces, different paper, and beneath the headlines, almost exactly the same sentence, written again and again by people who each believed they were describing something without precedent. Not one of those pages could tell its readers the number that actually mattered, not whether the market would recover, how long. Chapter 1. The Long Ledger. Read it the way a harbor master reads a tide table, flatly, in order, without alarm, because the entries are simply what happened. The Dow Jones Industrial Average peaked at 381 on the 3rd of September, 1929.
It bottomed at 41 on the 8th of July, 1932, a decline of about 89%. It did not close above that 1929 level again until the 23rd of November, 1954, roughly 25 years. The S&P 500 fell about 48% between its high of 120 in January 1973 and its low of 62 in October 1974, and did not regain that level in price terms until July 1980, 6 years. On the 19th of October, 1987, the Dow lost 22.6% in a single session, 508 points, closing at 1,739. It is still the worst day on record. It took roughly 2 years to recover the peak it had set that August. The S&P 500 peaked at 1,527 in March 2000, fell about 49% to 777 by October 2002, and did not set a durable new high until the 28th of March 2013. Its financial crisis peak of 1,565 in October 2007 gave way to 677 on the 9th of March 2009, a fall of nearly 57%, and that same March 2013 date closed both wounds at once.
In 2020, the index fell 33.9% in 33 days, from 3,386 on the 19th of February to 2,237 on the 23rd of March. It set a new record close on the 18th of August, about 6 months, peak to whole. And 2022, a decline of roughly 25%, from 4,797 in January to 3,577 in October, fully recovered by the 19th of January 2024. Now step back from the individual entries. Research houses that count these things, Ned Davis Research, in work widely published by Hartford Funds, identify roughly 27 bear markets in the S&P 500 since 1929, with an average decline near 36% and an average length of about 9.5 months. 27 in 100 years. That is simply how often the machine does this, roughly once every 4 years, and usually finished inside 9 or 10 months. Something changes when you hold the list rather than the feeling. The unanswerable question, will it recover, gets replaced by an answerable one. What is the historical range, and where in that range can I afford to live? Fear does its best work on the formless. A column of dates is much harder to be terrified by. Which raises an obvious question.
If the record is right there, plainly written, and has been for decades, why does almost everyone carry a mental picture of markets that is so much darker than what the dates actually say? Chapter 2. The Speed of the Fall. Consider what 1987 looks like from 2 distances. Up close, it is Black Monday, a single session so violent it still holds the record, 22.6% gone before the closing bell, a date that entered the language and never left it. Step back to the whole calendar year, and the S&P 500 finished 1987 with a positive total return of roughly 5%. Both facts are true. Only one of them is remembered, and it is not the one that describes what happened to a patient owner's money. The same asymmetry runs through 2020. Nearly everyone can tell you where they were in March of that year. Almost no one can name the 18th of August 2020, the day the index closed at a new all-time high. The fall got a name. The mend got a Tuesday. There is a natural version of this. After a storm takes down half a street of trees, everyone remembers the night, the noise, the hour the power went, the sound the big elm made when it came down. Nobody remembers the morning 18 months later when the last of the debris finally went and the replanted saplings stopped looking like sticks. The damage is an event.
The healing is a season, and seasons do not make the news. Behavioral research names the mechanism plainly. Kahneman and Tversky's work on the availability heuristic showed that people judge how likely something is by how easily an example comes to mind, and vivid, emotionally loaded events come to mind far more easily than slow ones. Your memory is not a ledger, it is a highlight reel, edited by fear. So learn to distrust the vividness of your own recall. When your gut tells you the market is mostly disasters, that is the editing talking, not the record. The correction is to go and look at the dates. But there is a harder problem sitting behind all of this, and skipping it would be a kind of flattery. Distrusting your memory only helps if the record itself is honest, and the phrase people hand you, the one that goes, "Markets always come back," is not honest. It quietly smuggles in 3 claims that are untrue, and there is a 4th that has nothing to do with the market at all. Chapter 3. What the Ledger Doesn't Promise. Start with the case that should unsettle anyone. The Nikkei 225 closed at 38,916 on the 29th of December 1989. It did not close above that level again until the 22nd of February 2024. 34 years. An investor in Japan who did everything correctly, held on, kept contributing, never panicked, never sold, and simply happened to be born in one country rather than another, got a generation of nothing. Not a lost year, a lost career. Second, decades can be barren even in the market people hold up as the success story. The S&P 500's total return for the 10 years from 2000 through 2009 was negative, cumulatively around -9%. A full working decade of contributions rewarded with less than nothing. Third, individual companies do not obey the arc at all. General Electric peaked near $60 a share in August 2000, closer to $480 in today's money after the 1-for-8 reverse split it carried out in 2021, cut its dividend during the crisis, and in June 2018 was removed from the Dow after more than a century as its last surviving original component. It never regained that high. Citigroup, adjusted for its 2011 1-for-10 reverse split, peaked above $500 a share in late 2006, and 2 years later required a $45 billion federal rescue. Neither of those was a speculative name. Both were what careful people called safe. And the academic record is harder still. The Dimson-Marshall-Stoughton dataset behind the annual Global Investment Returns Yearbook tracks equity markets from 1900, and it includes the ones that simply stopped. Russian holdings extinguished in 1917, Chinese holdings in 1949. Not a decline, a zero, and a line that ends. Fourth, and most practically, a recovery that arrives on schedule can still arrive too late for you. Think about someone who was 62 in 2008, drawing an income while the index fell 57%, selling units at the bottom to buy groceries. The market got its money back by 2013. Some of that portfolio never did, because those units were gone, sold at the worst prices of the cycle and unavailable to participate in the rebound. That is sequence of returns risk, and it is the part of this subject that almost nobody puts in a video because it doesn't resolve neatly. So 4 honest holes. What actually defends against them? Not optimism, structure. Global diversification answers the Japan case directly. The same Dimson-Marshall-Stoughton work finds world equities returned roughly 5% a year above inflation from 1900 to the present, and that figure already contains the markets that failed. It contains 1917 and 1949. A global index owns the survivors and the casualties together, which is precisely why its number is trustworthy in a way a single country's number is not. Owning the whole index, rather than a handful of admired names, answers General Electric and Citigroup. The index absorbed both of those and kept compounding, because that is what an index does. It buries its dead and carries on, without sentiment, without loyalty, without needing anyone to have been clever about which name was rotting. A genuine time horizon answers the lost decade.
Money you will not touch for 20 years can afford a barren 10. Money you need in 3 years cannot, and pretending otherwise is where most real damage begins. And a deliberate buffer, bonds and cash, sized to cover several years of withdrawals, answers sequence risk, because the entire harm comes from being forced to sell into a fall. A buffer is simply the decision, made in advance, not to be forced. Which leaves the version of the sentence that is actually true. Not the flat version, it always comes back. Rather this: a globally diversified whole has tended to recover over long horizons for an investor who arranged their life so that no falling market could compel their hand. That is a weaker promise. It is also a far sturdier one to stand on, because nothing in it depends on you being lucky. Notice what just happened, though. Every one of those defenses is about the market's failures.
None of them touches the failure that costs ordinary investors the most, the one that happens in an afternoon, with the best of intentions, and doesn't show up in any index at all. Chapter 4. The Cost of Standing Outside. The instinct in a panic is to step outside until things are clearer, not to gamble, to be prudent, to stop the bleeding and wait for visibility. J.P. Morgan Asset Management runs a study each year in its Guide to Retirement that puts a price on that instinct. In the 20-year window from 2003 through 2022, $10,000 left fully invested in the S&P 500 grew to $64,844, an annualized return of about 9.8%. The same $10,000, missing only the 10 best trading days out of roughly 5,000, ended at $29,708. Do that subtraction slowly. $35,136, more than half the entire result, removed by being absent for 10 days. 10 days out of 5,000 is 0.2% of the period. Missing the 20 best days left $17,826. Missing the 30 best left $11,701, a gain of $1,700 on 10,000 across 20 years, which works out to under 1% a year. 2 decades of ownership, reduced to roughly the return of a savings account by 30 absences. And the detail that turns this from arithmetic into a behavioral finding: the same study notes that 7 of the 10 best days occurred within 2 weeks of the 10 worst days. The great days are not scattered across calm years, waiting patiently to be collected. They stand right next to the terrible ones, in the middle of the fear, often in the same fortnight. Which means the exact conditions that make a sensible person want out are the conditions that manufacture the days they cannot afford to miss. Put a face on it. A careful saver, 30 years, never a missed contribution, moves everything to cash in late February 2009, 3 weeks before the bottom, having concluded, quite reasonably, that the banking system is breaking. They are right about nearly all of it, but now they need a second decision, and nobody mentions the second decision when they sell. When do you go back? 2 weeks later, the market is up sharply, and buying feels like chasing. 6 months later, it feels expensive. A year later, it looks like a bubble built on stimulus. Every single re-entry point is disqualified by the same caution that had served them so well in February, because caution does not switch itself off when the danger passes. It has no such setting. The selling took 1 afternoon. The not buying took 9 years. So your only real job during a panic is a negative one. Simply this: don't convert a decline on a screen into a permanent loss in your life. A drawdown is something that happens to your portfolio. A realized loss is something you do to it. That distinction is easy to hold in a quiet room and very hard to hold at 2 in the morning. So the last question is the practical one. What makes it hold when you are inside the storm rather than reading about it? Chapter 5. The View from the Ridge. There is a figure in J.P. Morgan's Guide to the Markets that most people never see, and it reframes what a bad year actually is. Across the period from 1980 onward, the S&P 500's average intra-year decline, the worst drop inside each calendar year, is about 14%. In the same span, annual returns were positive in 34 of 45 years. Those two numbers don't feel like they belong to the same market. A typical year contains a 14% fall somewhere inside it. A typical year still finishes up. The fall is the ordinary interior of a good year, the toll charged in advance and in public. Think of a river seen from a raft and then from a ridge.
From the raft, it is all hazard. The drop ahead, the rock, the cold, the sense that the whole thing is trying to end you. Every entry in our ledger was a raft experience. 1932, 1974, 2009, March 2020. From the ridge above the valley, the same river is a silver line moving steadily downhill, and the rapids that nearly drowned you are a slight roughness on the surface, visible only if you know where to look. Both views are accurate. Only one of them is a good place to make decisions from. Nothing about the river changed between those two views, only where you were standing. Consider what the ridge shows for one ordinary life. Someone who began investing in January 2000 chose, in hindsight, close to the worst starting month of the modern era. They then walked straight into a 49% decline, a decade of negative total returns, a 57% decline, a pandemic crash, and a 25% bear market. 5 of the entries in this ledger fell inside a single working career. And someone who simply kept contributing through all of it, buying in 2002, buying in 2009, buying in March 2020, when every purchase felt like a small act of foolishness, was not rescued by timing or by luck, or by understanding the news better than anyone else. They were rescued by arithmetic and by not interrupting it.
So choose your viewing distance on purpose. Check the balance less often. Lengthen the window on the chart before you look. Judge a decision by the decade rather than by the afternoon. From the ridge, you are looking at the same water. You are just seeing a longer stretch of it. Here is what the ledger really gives you then. Not a guarantee. You've seen the cases where the arc bent the wrong way for 34 years or never came back at all for a company people once called safe. What it gives you is proportion. The timetable nobody handed you, with 25 years at one end and about 6 months at the other, and 27 of these things in 100 years, averaging 9.5 months. The next decline will arrive, and it will feel unprecedented, because they all do. That feeling is simply what being inside one is like. And when it comes, you'll already know the 3 questions that matter. Is this money I need soon, or money I've promised to leave alone? Am I spread across the world, or quietly betting on one country's next 30 years? Do I have enough set aside that no falling market can force my hand? If those answers are in place, the panic becomes weather, something you wait out rather than respond to. You're allowed to close the app and go and live your Tuesday.
The people who ended up fine, across every episode on this 100-year list, were rarely the cleverest in the room. They were the ones who had arranged their affairs so that they never had to be clever at the worst possible moment. If any of this settled something for you, I'd be glad if you subscribed. This channel is a slow one by design, and there will be more evenings like this. And if one thing in particular stayed with you, whether it was the 34 years in Japan, the 7 best days hiding among the 10 worst, or just the river seen from the ridge, leave a comment and tell me which one. I read them, and I'm always curious which part lands. Until next time, take your time.